Welcome everyone to the Kendall Report, where I share my 44 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. I decided to do a special Sunday night stream tonight, and I'm calling this the Great Petro Dollar Scam. Let's get into tonight's video. Well, welcome everyone. I know it's going to be slow filling up the room. No one was expecting me to be here tonight, but hopefully you'll get a chance to watch the replay of this. So I'm calling this the Great Petro Dollar Scam, and it's just making me crazy. I see one more Twitter, one more YouTube video on how the reserve currency of the US dollar is over and that the Saudis are dissing the dollar, and that's not what has happened at all. And by the way, there never was a signed deal between Henry Kissinger back in 1974 and the Saudis. It's been a handshake deal. There was no official anything to expire, by the way. And I'm just tired of hearing all this stuff. So here's the deal from my standpoint. We've seen that I'll cover the dollar here in just in a few minutes, but we're not seeing any movement in the dollar. Everything didn't change. The payment systems of the planet didn't change. We're still in the SWIFT system that everybody uses to pay for shipping and pay for oil and all that. The fact that Saudi said they're going to accept oil in something other than just dollars is no big deal, in my opinion here. There's no BRICS currency. There's a lot of talk about forming one, but there isn't one. And folks are already trading between each other for one primary reason, is because of all of the sanctions against Russia and with the Ukrainian situation. This has been going on for almost over 2 years now, right? So nothing has changed at all, and the cash flows aren't going to change. And I'm tired of hearing that everything's going to fall. You got the hyperinflation guys, the metal guys screaming, watch out, the sky's falling, the dollar's going to go to zero, buy gold, it's hyperinflation, we're going back on the gold standard, all of that stuff. And then you got the other guys that buy Bitcoin and all of those folks out there. And then it's just trying to create chaos. So the Republicans are using it against Biden because it's his fault that this deal fell through. They didn't have a new deal to replace the old deal. There never was a deal. Okay, it was handshake, and everybody just operated on that for years. And I can tell you, since the invasion and since all the things that have been enacted against Russia have been in place, they've been already doing this. This isn't anything new. I was in Dubai year before last, and half of the people there were Russians. Okay, so it's just not the case here. So I just we'll cover the dollar. The dollar's actually done better since this so-called announcement last Sunday. And it makes for a lot of hyperbole for folks to get all excited about and to really try to hype up. So I'm calling this the Great Scam because everybody's doing it. I saw MTG going, this is all Biden's fault, and the dollar, they're going to destroy us. And I mean, come on, I don't see that happening. So for instance, even if they take, let's say Saudis take whatever, anything from rubles to whatever, they're going to convert back the dollars to use it to do whatever thing they do. The entire world system's still on the dollar, and there is nothing to replace it right now. No one wants to trade in yuan. No one wants to do these things, and they're not going to. Nobody in Europe, none of the Western, including China, are going to continue to do dollars. So let's get over that. Okay, enough of that. So I wanted to come on just to talk to you folks because we haven't talked for a while. I keep telling you, get the Substack. I work hard on the Substack every day. I try to come up with some pretty good content, also make it condensed so you can get the idea of what's going on in the markets. But sometimes you just got to come on and talk. I get it. I was looking at some videos. There's a couple other things I want to let you know about as we get into today. We're going to do a mastermind, like a think tank, with everybody that has the indicators, but I'll be telling you how to get involved in that. And I'm also going to be starting reviewing some stuff from our private Discord and talk about questions there. So if you have questions on how to use the indicators and all that stuff, go to the Discord, start putting them on there. And I'm going to do probably a weekly video where I just talk about some of those things. But I'll give you the dates and everything. We're working on some stuff. We just started working on this in the last couple of days and putting this mastermind think tank together, because there's some brilliant people. Most of you people are very smart and you have a lot of good ideas, and we've seen a lot of feedback and good concepts and stuff that you folks have learned how to use these indicators. If you don't have them, kendallreport.com/indicators. There's a special price out there for $347 right now, and there's an order bump there where you can get a 6-hour course. But we're basically going to do a live six-hour course coming up, which I'll announce here very soon. So into business here. Markets continue to move higher. Everybody wants to tell you that the markets are stalling and the Dollar's falling and everything's going to happen that are negative. Well, meanwhile, I'll touch on the database. I'm going to write this all up, basically what I'm talking about, on the Substack here in a little bit. But the point is that the markets are still in a very strong uptrend. We're continuing to see the database, the WaveTech database, up around 62% on the intermediate. We're pushing 52% plus now on the daily or the short-term database. Lots of traction. People are talking about how there's an internal, the total S&P versus the weighted S&P. There's underperform. This is all just a bunch of gibberish that's out there. And the beauty of you folks knowing me and the channel and maybe getting the WaveTech products and all that stuff is that we look at something completely different. We look at all of the individual stocks in the database, the mutual funds, the ETFs, and in that database is literally 15,000 symbols that represent those things. So we don't look at a bunch of indexes and start to make decisions about what's going on. We have some portfolios which I plan on reviewing very soon that have done incredibly well. And you don't have to be a rocket scientist to figure out these things. And this is why I've spent my entire life has been on trying to create these products and to automate investment process. And I've done that successfully for decades and decades. And so, but as we look at the markets, we're just seeing this funny rotation. These happens. Markets narrow out. We've watched over the last couple of years from the FANGs being the driven, and now the Magnificent Seven. And we've got, NVIDIA, that's the next bubble. That's another story that's running out there. Everybody's waiting for it to fall and collapse and all that stuff. I strongly suggest, if you haven't seen it, to watch Jensen Huang on his keynote that he did in the last couple of weeks. It kind of blew my mind on what's possible on all of that stuff. I'll let you do your own research on that stuff. Is there a buzzing noise? I was testing this. This machine hasn't been cranked up, and I don't know what's causing that, by the way. I tried to fix it, and I wasn't going to spend a lot of time, so I apologize for that. So I turned that down. Let me know if the buzzing noise got better on what I just did. I just happened to look over and see that. Anyway. So I just looking at a couple comments here while I'm talking about these things, and what I'm going to do is just go on for another minute or so and talk with you folks, because I don't get a chance to do this as much like in the old days. But we'll go through a quick run through of the indices. Like I said, I'm going to write all this up in the Substack, so you can go kendallreport.substack.com, or you can actually go to kendallreport.com/newsletter and get to the same spot. Okay, I just wanted to make sure I did have a buzzing. I was testing something earlier, so I cranked it down just a touch. So let me know if it's not loud enough, all that. This old machine hasn't been lit up for a while. So let's just go on about some of the things that I'm seeing in the database that kind of debunks a lot of the rhetoric that is flowing around the markets, right? This whole, everybody, like I said, if I put out, so I'm calling this we'll see what kind of clicks I get on this video. It's been kind of interesting. If I were to go, Bob Kendall sees a crash coming, tune in now, it would get a lot more views than if I said, market to continue higher. Okay, maybe that's not exciting. The doom part of that headline is always sells better. You always get more clicks. I've never been about the clicks. I'm trying to give you some honest viewpoints here on what I see coming out of the unique database that I have control over. I don't tell it what to do, but I built it. I built all the algorithms and things that are in it, and they've been around for decades and decades. So we have a lot of background information here. It's been tested in the trenches for decades. And so what I'm seeing here is just still a rotation. We saw the short-term database come down to around, I think it was around 12%. It's back at 52%, and it's finally stable because we were watching it bounce around from very low percent. It would come back to around 35 to 40 and then just get hammered and come back down again. We're not seeing that volatility. We're also starting to get some sectors to come into play. And so that's a good sign of stability, even though we're printed, all-time new highs again last week. So as we print, it's interesting. I've been around a long time, and I've been using this database for a very long time, like 25 years. And it's an interesting scenario we're in right now. Let's see, while I'm talking about this, let me just see. I've got about 400 tabs opened here on my computer. Let me see if I can bring this up for you just so you folks can see a little bit about what I'm talking about. So let's go here, and this is, let me come over to the other side here of the screen. This is the 62.02. We have 9,349 symbols. This is a respectable amount of symbols that are long here, and that is, really typical in this kind of environment. Like I said, it's interesting because while we printed new highs on the indexes, if you look at this screen here, I'm just trying to see if I can pop this up full screen here. Not going to give me that option here. Yeah, here we go. Yeah, so this is, I'm going to try to bring this up so you can see it. This chart here, this is the VPM universe. This is out of the database. It's not printing new highs. We're starting to see kind of an ABC. We're right on support here, and there's some consolidation going on. And what I want to do here is to get this, bring into a perspective of the, from the standpoint of what the database is doing. We're seeing a little bit of a rotation here at these levels. So we've got 62.02% long right now. Let me see if I can move this around just so you can see this a bit better. The the scenario that I'm seeing here is some rotation. I think we are going to continue to back off. We actually had about 1,000 sells, with 325 buys. So we're getting a little bit of a negative rotation on the database right now, and that's just telling us that it's kind of refreshing on that standpoint. We have a number of sectors that have rolled out of the bullish part. We now have basic materials, conglomerates, cyclical, consumer non-cyclical long, and financial and services and utilities is still long as far as the sectors go. And like I said, we've got a bit of a negative rotation. You can see here on the chart. Let me just draw this in and make sure everybody's got eyeballs looking at the right spot here. So right here, you'll see, bear with me a second. So right here, you'll see the all negative. It says sentiment negative over here, right in this area here. And what that's telling us is just that there's more selling than buying coming in on both ends of things. From the standpoint of what the rotation is going on in the intermediate. If I come over here to the daily, you'll see 51.33, so right around 52%. Anything over 42 is positive, so that's pretty good. So let's go ahead and get through some of the other markets, and I'll probably continue on with some of this rant that I have. And thanks, everybody. Happy Father's Day to everybody out there, and I appreciate that. Thank you for the nice thing. It's kind of interesting, I think, just looking at a couple comments here, and, there's no blow off tops. I hope your long way is blowing off, because you don't want to miss that stuff. Too many people sit around waiting for the blow off air quotes on this. So let's go ahead and take a look at the S&P here. All right, so this is a daily chart. We're seeing what my expectations are is that we are going to consolidate here. The database is telling us that we're going to have some rotation. And this is the interesting part about getting a rotation at these levels, because the market's basically refreshing by taking some symbols out. It'll narrow down a little bit, and then typically it will start to rotate back into the markets again. Yeah, so I don't know how many of you saw the video I put out the other day on the projections and things, and on interest rates, and I do need to unpack that just a little bit further. So, man, we could spend a couple hours together, and I'm just going to keep this thing as tight as I can. I'm 18 minutes in. I'm hoping to get out of here in about 30 minutes, and I'll try to answer some of the questions you folks are coming up with here. But this, you can see there's still a positive flow. We're probably going to remain above this 10-period moving average. I don't see us getting close to that right now. That's around, right now, this is with the September contract rollover that we just experienced. It's already normalized pretty good. And I'm going to show you in a minute. We got an RTX sell signal on weekly NASDAQ and on weekly S&P. You can see the algos are suggesting that we're going to flatten out a little bit, but I think we remain above 54.60 or something like that. Like I said, I'll have some time to really break this down in the Substack. Let's go over to the weekly chart here real quick, and so you can just see what's going on. And the weekly chart, we got pretty nice slope coming up all the way into July, probably coming into August is where we're likely to stall. This is getting to be a fairly wide range from that standpoint, but we did get this close above the market grid on Friday. This same thing happened on the NASDAQ. And what that suggested, we get 1 to 2 weeks in a sideways range. That would make a lot of sense. We had, there's so much more I could have went on, and as far as the market, I'll come back on screen here for a minute because, you know, last week, you think about, we got CPI, PPI, you know, the disinflation's coming into play, and then you've got, you know, the Fed. I see people complaining that, you know, the Fed says they're data dependent, but they got good data and they didn't change their forecasts, all that. I still maintain something I've been telling you folks, both on Substack and when I have been up on YouTube, is that we're really looking at the standpoint from, I still think there's going to be a bit of a bounce, and CPI and PPI, no, but it's not until September and October. We get those reports in October and November, right before the election, because you're always looking in the rear view mirror on those reports. They're a month lagging. So we won't know those actual numbers until then. We'll see what comes out of all this stuff, whether we get any kind of bump in oil prices or any of those type of things. So short of spending hours with you tonight, I'm going to try to condense a lot of this as fast as I can. And somebody's talking about the, you know, the possibilities of recession. I did use the R word in a Substack. Is there a recession coming? I've become a little bit concerned, and I would say I'll probably do more of a macro. I'll post a video sometime this week that will cover more of the macro environment from where we are right now. But the scenario that's playing out there is really, there's no recession likely right now. We have narrowed, as I was just showing you, database. There's only, I think there's 5 or 6 sectors that have bailed out of the intermediate models now, suggesting we've gotten a little bit of a tighter focus on the sector basis. And that's the way the markets always get. So you get sometimes broad participation, but ultimately it starts to narrow down and narrow. And then at that point, then maybe you could start to call for some sort of top or those type of things. And I would love to, I would love to have the opportunity to do some stocks, and I've been threatening you folks, and I'm working on it, I promise. As you know from some of my past videos, there's a lot going on in the background in my personal life, so juggling some things that are coming out, and I'm going to put out a video also this week on something that I think you'll find intriguing as well. So I've got plenty of plans this week. I've got a lot of things on my plate. So, but as far as recessions, as far as we're seeing interest rates, we're seeing I see people also talking, oh, wait a minute, the yield curve's steepening more right now. The reason why the yield curve's steepening right now, and I've been saying this for a while, is that the only thing you really need to watch, the front end of the market's being fixed. And let me see if I have a chart here, because I think I can cover this fairly quickly here if I can find something here. I can. So yeah, this will work. So it's a little bit smaller, but let me bring this up on screen for you. So let's talk a bit about this, and it's kind of crunched up really weird. So let me see if I can get this to look a little better for you. This is going to kind of jack up things to do this, but I want to talk about this a bit, because this is a chart that I put out into a video the other day, but I've noticed something that's interesting. So let's get into talking about the Fed here just a little bit. Is what we're seeing is that now that I fixed this chart here, I've got to fix this again. Bear with me a second. All right, I'm just trying to get out of the way. I am getting out of the way. Sorry about that. Thought it would be better. So a couple things that happen. If you look at this yellow line where my cursor is right now, that is the taper tantrum back in 2018, right, coming right into 2020, where rates were coming up. We're getting steady. And I drew this blue line across here because it's showing if the pandemic hadn't happened and they dropped rates to zero because they shut the country down, this trajectory of these interest rates were heading right for where we are right now. And the other thing I notice, anytime there's a flat where the Fed holds policy for multiple meetings, they tend to reverse and go the other way. So we had this reversal here. We've got the same thing going on now. I'm projecting that the first target drop is going to be maybe in November, for sure in Q1 of 2025, and then this steady decline. This is what the algos are suggesting, and if that will happen, if that happens, we're looking at 26, 27. This is a steady drop, and I have a scenario which I'll try to play out for you a bit. Is my expectation is that the back end of the curve is going to stay right where it is right now, and what we're going to get is the back end of the curve will stay 380, 450, and then what's going to happen as we come into 25 and 26 are going to continue to drop the front end of the curve, and then we'll have a normal slope yield curve, and you'll go from the inverted yield curve to a normal steepening curve, and that will where the short end of the market will be $1.50 to $2 below what the back end of the yield curve is. So you'll get down to potentially 2.5, 3.5 range on Fed funds front end, short-term money, and then you'll have 4% on the back end. I don't think the back end of the curve is going to change much. There'll probably be fluctuations where it drops down, could go as low as 450. I've got projections of 450, 350. That's a possibility, down to 3.25. But they're going to rebound back from there, because at that point in time, you'll start to see demand pick up and other things happening. There's another reason that I believe that the front end of the yield curve is going to drop. Not everybody's buying what I'm going to say right now, but I'm going to try to sell it to you again, okay, is that I believe that productivity is going to increase substantially in 2025, but it will 26 and 27, you're going to see productivity start to really increase, and therefore GDP go up. And the whole debt ratio, a lot of ratios that everybody's talking about right now are going to change substantially. Everybody assumes that everything's going to stay static, and if it does, and rates go higher, all that stuff, once again, the doom scenarios start to come out. Well, there's no one talking about the potential productivity, and why is that going to happen is because, and I'm arguing this point, and we'll find out. It's going to take a while to find out whether I'm right or wrong here, but the bottom line is what I'm expecting is that productivity is going to change the balances of GDP versus debt, and then we'll continue to spend more money because the economy will grow and continue to get bigger, especially when you bring in, I don't know, 20 million people out of nowhere. That's happening. A rumor is that Biden's going to sign some kind of executive thing, giving amnesty to millions of people, like Tuesday, something like that. I just heard this earlier. That's interesting. And but this is also what the Fed has been alluding to here, is that they've been talking about the immigration bump that we've gotten, and that's fulfilling some of these jobs and all of these elements. And I've been saying this for a while. They're using the so-called, I'm doing immigration as a cover for their window dressing the economy, making it look better. There's a bunch of us that would argue that the economy is really bad. Costs are up, everything's up, and it's a very bifurcated environment that we're in. But this chart I was just showing you, it does suggest that yields are going to start to drop. Now, there's two things you could draw from that. Is one, that the markets, that's going to represent a recession of some sort. That's why rates go down. And that could be an option down as we come into year end. Possibly, maybe we have a new administration then. Maybe there's some new configurations of everything. That's a possibility. The other possibility is the one that I just was telling you, that I think we could see the productivity increase, therefore GDP output go up. The single biggest multiplier, everybody should know, Econ 101, right, is productivity will multiply GDP. And if you can get that number going at some crazy numbers that I think that AI is going to do, I think when GPT-5 comes out, it's going to absolutely blow up a whole lot of stuff. There's going to be probably job displacement, but there's going to be a lot of good that comes out of it, especially on a productivity side. And that's kind of where I'm looking out. I'm very big into AI. I'm looking at some amazing things that are capabilities that you can do now that you don't even have to program to do them. I grew up in a world, I've been running software companies since 1992. And, you know, this world has changed substantially in the type of things that you can get without doing any kind of special programming or anything right now. So a lot of this stuff is going to start to flow in to more and more into companies that are going to give them a lot of productivity gains. And that's my whole scenario. I think that's the reason why rates start to come down. I don't necessarily think it's a recession. I know I've seen people talking about, you know, how the Fed's ruining everything. They're not dropping rates. I've been telling you, they're not going to play that game again, but they are going to adjust to market demand, and that could be lower rates on that front end. So I think I've probably sunk my putt many times. Yeah, so let me look at a couple questions here. This was kind of a random stream tonight. Yeah, I don't know. IWM, I don't think is a play. Let's take a look at that. So I'm going to be pretty interactive tonight, and for the micro analysis on everything, I will tell you and direct you to the Substack, and you know, so get the Substack. It's $8 a month. It's not a big deal. I do. I have some plans of putting some really interesting reviews out. I've been working on a couple things that I think you'll find very interesting. Yeah, I said like Drunken Miller. Let's see here, NVIDIA. Now the dude's long IWM. Let's just go to. We'll go ahead and use the Russell. Let's come back. Let's go over here. This thing, man, I'm telling you. Let's go monthly. So I've got IWM back to 2,000 here on the screen, and we start looking at, I don't know why this thing doesn't calculate right. Hang on one second here. Let's just do the Russell. I don't know why the indicators aren't calculating on this. Let me double check something. See if this is going to fix it. This is somewhat frustrating. There should be plenty of data. Yeah. Matter of fact, I'm going to show you folks something. Those of you that have the indicators, I've been doing the, we're going to add, let me show you how to do something, because this, I've seen a bunch of questions, so hopefully you got deep enough into this video to see this. But I'm just going to grab the WTAR forecast. I'm going to put that on. Hopefully I did. I might have doubled it. Let's go here. And what I'm going to show you is something I came up with, and how to forecast the so here we go. Yeah, I did get two of them on. Let me get rid of one. So if we come up here to the settings, and I'm going to change the periods from 10 to 1, and I'm just going to make this black. I don't care about the back, but what I do care about is the projections going forward. I'm going to make red, okay, and then the thickness, I'm going to make it about a 6, and I'm going to set this to 50 on the back, looking back. Okay, so what I just did, the red dots that you see on the screen, so if you have the indicators, people have been asking me, how did you do the price projection? So I set you can change the settings on these indicators. So what I'll bring this settings back up. I just changed it to period of 1. So basically it's a 1-day moving average, which is the close, okay? So you're basically telling it to look forward. I'm telling it 50 days. I'm going to do, in this case, this is monthly. And so I'm going to go out for the next 20 months. And what's being forecasted, where this becomes somewhat, we'll say if the forecast is right, that IWM's going nowhere for a while. And I still think that these zombie companies in here, if you look at what's in here, there's a lot of the banks are just not good companies in these small caps. I still think possibly it comes up the same way, but if we do MDY, you'll see MDY is pretty flat as well, and compared to SPY, which has a higher forecast here. And so what we're really getting, as far as IWM being a buy, everybody wants it to be a buy, okay, but it's not a buy. Typically, those of us have been around for decades like me, we're used to saying, okay, this is when you get the next rotation, next bull market, when the small caps kick in and they carry the way up, and then you see a thinning of the large caps, and that's the way it always works. Well, it doesn't always work that way, because we're coming out of, I think, an interesting scenario here, folks. And the best way to put this is we came from, when I was showing you, I'll bring this chart back up in a minute. When I was showing you the forecast, what we're seeing here is in my opinion right now, the rates on the front end of the yield curve being fixed at 5.25 plus, those are about as manipulated as they were when they were 0.25. We should have never been 0.25 for 17 months, right? But what we should have been was probably 2.5, 3 at that time, but they were being artificially held down by the Fed. I believe they're being artificially held up by the Fed right now, and this is why it's interesting that the forecast that I was showing you on the Fed funds just a little bit ago was exactly that. It's showing you that the front end of the yield curve is going to come down. And when we look at, let me just put this chart over here, and I'll bring you back up here on the screen 1 second here. And this is really interesting. Let me bring this back up for you. This is the forecast for the 10-year, right? So this is the 10-year notes. They're being forecasted down to 2.5, but this probably around here, this is what I was talking about, a 3.6 range. That puts us back into June of 25. I think, matter of fact, I think looking out this far, what I've been looking at, a couple things here on this forecast that I have on the screen for you right now, is that what we're beyond, when you use the monthly charts for this forecast, it's pretty good. The shorter term you get, the more noisy it gets, means it's not really as good as in the predictions as it is on monthly. So you get too much movement in here, and these algos are just going to be projecting over. But for the long term, this is suggesting, and if we look at what's going on here on this screen, that we're going to come into these moving averages. And so just going back to the crux of wave tech and my entire career here, this is what is going to be going on. Is so we have this average right here coming up, This is probably where this market will come down to. That's going to be roughly 3.6. I'm going to say 3.6, maybe 4% is possibility. We're 420 right now, right? So this isn't even that big a deal. But we're gonna work our way down into this level over time, and then I think we just stabilize. I know I got a bunch of lines, but then I think we just stabilize in some kind of range over here, 360, 4.25, and then on the front end of the curve, we'll get this. So I'm gonna draw in the what the yield curve, what I think is going to look like. Let me move this over here. I can't do it. Hang on. Yeah, so from the yield curve standpoint, I think this is what I've been trying to explain to you folks as I've been going on here for a while, is that the yield curve is going to start to look more like what I'm going to draw on the screen here in 1 second. So what you'll get is more of I'll just do a box here. So this is going to be like 4% right here. And so the long end of the market will be here, and then we'll have the short end of the market. This is going to be like 2.5%, 3%. So you get 150 basis points premium to the back end of the market. I think that's where we end up, somewhere mid to late 2025. So we're looking at basically a year out. That's where I believe this is going to end up at. And yeah, so hang on, let me clean this up. Yeah, so I forgot how fun it is to hang out with everybody here. I appreciate somebody's asking, what about crude oil? Maybe I'll bring up crude. I guess we're just going to do an hour like I normally do on these streams. The whole scenario that I'm playing out here, I think we're going to see more of a stable market coming in. Like I said, we're getting negative rotation on the database. I'm going to try to compile some of this. And interest rates look like they want to come down a bit more. We're at 420 now on the, what's the last, 418 already. So coming to 380, 420, that's not that big a deal to get there. What's not happening right now is that front end of the yield curve. And I don't think they're going to move this, folks. I keep telling you, they're going to keep these rates up here. And the Fed, are stuck into where they are right now. And I don't think they're going to crush the markets, because the front end of the curve does not have as brutal as effect as the back end. And you can already see the back end of the curve is starting to adjust. We're at 418. So that's where market rates are going to be mostly realized in the economy. So while people are trying to continue to jawbone, and this is a recession and all that, really what we're seeing is some softer demand, and that's what's being reflected on the back end, especially in real estate, some other areas. But I don't think it's full-out recessionary collapse. I've been telling you I expect unemployment to go up to 4.25, something of that sort. I don't see the full-out collapse of the markets. Now, hopefully if I see these things start to come up in our database and other activity, then I'm going to talk about them. But right now, it looks like a very normal type of rotation that's going on here. So let me look at a couple questions here. Yeah, just a little back on that IWM trade. Man, I mean, I remember it's probably been a year plus. I thought you'd be able to do a spread, IWM against the NASDAQ, and NASDAQ just completely taken over again. You look at the S&P led the way until about 6 weeks ago, and then all the large cap tech stocks took over again. We're seeing this huge bid in the tech stocks, and all of a sudden we're up 17, 18% on NASDAQ, while the S&P's up 14, 15, where it was about a 1% advantage toward the S&P for most of the year. The S&P was a bit stronger, and all of a sudden we saw that all change. So let's and Jason, you are 100% right, and this is what is that the bond market does decide what the yields are, and that's what the Fed has been telling everybody. So I'm an old dude. I grew up in the markets in 1979 is when I started, and right end of Jimmy Carter, beginning of Ronald Reagan, and rates went up to 20% roughly, actually a bit more. And so what happened is the Fed did make a lot of controls at that time, but ultimately, if you went back into Arthur Burns and some of these other old Feds, the Fed was always adjusting rates to the markets, not the other way around. The Fed didn't lead the way. The tail didn't wag the dog. We're so used to the tail wagging the dog that people think that's how it works. It doesn't. We're now into the mode, and this is what the back end of the curve is getting softer, and that's why you're seeing this. And sometimes it's hard when I'm doing my analysis, like I've been telling you rates aren't going to come down for a while, and the front end of the curve, I think we stay. They could go in a September move, but I think November meeting they're going to try to come and stay non-political view from the world. There was some, I know there was some whistleblowers and some people that came out that I heard. I don't know if it's very widespread that Powell doesn't like Donald Trump and that all these different issues, and that they're very left-leaning at the Fed and all that stuff. Maybe they are. I don't know. They're not supposed to be political, but they are. We've known that for many years. But the situation that we're dealing with here is that the back end of the curve is going to determine that. They are going to see rates start to come in on the front end of the curve. It's going to be interpreted misleading by what I'll call the, no offense to anyone, the millennial hive mind will come into play. And the fact that if the Fed does anything with the yield curve and anything on the front end of the yields, everybody's going to be, the recession's coming. They're afraid of recession. Yeah. So, listen, I was talking to an old friend and someone I used to work with many years ago, like 35 years ago. I think it might have been longer than that. We worked together a long time ago, and I was saying, could you imagine if we would have had Twitter and all the social media, and we could have what it would have been like back in those days. And right now you've just got, one of the hard things I had to realize the other day is that I once upon a time was the 35, 34-year-old analyst that managed to get some prominence and be able to put my opinions out on a lot of people in the firm. And a lot of the younger, there's some good analysts out there, but most of the stuff you see out there, especially because of YouTube, are just amateur. And some of these people might have a couple million followers, but these guys are really, really bad. And everybody kind of knows it, but it's like we like to hang around people that think like us. And so we tend to get into that hive mind. But the bottom line is that the Fed is going to let that happen. So I appreciate that comment there. Now that hey Christoph, I haven't seen you for a while. How's the best way to put this? Tug of war, the 2-year is totally irrelevant, in my opinion, to anything. I never look at the two. The 5, 10s, 30s are more relevant from a market standpoint. There's most of the financing is done on that back end that really is big. And I know, like if you're in Canada or Australia or even the UK, I think mortgages roll like every 2 to 5 years, unlike here in the States where you can get a 30-year fixed loan. and there's a lot of those out there, that people that were smart, that were borrowing money, borrowed at 2.5%, 3%, look pretty smart right now, and they're probably not going to move unless they have to. But the whole scenario of everything, that you have to be really careful in what you listen to. Of course, here I am on YouTube asking you to listen to me, but I try to normalize a lot of this rhetoric. And like I said, that for me, the whole petrodollar thing, everybody's got an agenda on this. I don't care if you're a politician or you're a market person, you're selling gold. Everybody's got an opinion on the petrodollar. I'd be willing to bet they're selling something. That's what I would be willing to bet. And they're trying to sell some scenario. They're trying to sell gold. They're trying to sell whatever. And the whole world dictates around this. So let me just see if there's anything else, and we're going to call it quits here. Right at 50 minutes. Yeah, I mean, somebody says more money in the bond market than equities. Absolutely. The bond market's huge. The biggest market of all is currencies, right? Everything's priced in currencies. That's the biggest commodity market in the world. Then you got bonds, and you look at all the debt on the planet, there's a lot of it. And, so... Yeah, I know some people saying that markets usually go up in election years. Yeah, that's true, but not always. There's been actually recessions in electoral years as well. But anyway, yeah, I'm not big on seasonals. Yeah, so I never covered it. I did. I said, basically, there is no, very first things when I started here, let's see here, JH went maybe on the replay if you came in a little late. So basically, here's the scam, is everybody's trying to use it to their advantage. I'm talking about that right now. The petrodollar scam is that, number one, there never was an agreement. If there is one, put it on the internet for me. Go to my Twitter account at Portfolio Expert. There's no E in the expert. Post it, because you're not going to find it. There was no document. There was no agreement. All it was Henry Kissinger and somebody back in Saudi in 1974 shook hands, said, hey, buy everything in dollars, and they did that. They're taking in other currencies, and ultimately most of the money that even comes in other currencies will get converted over into dollars for whatever, shipping, insurance, and everything else is priced through the SWIFT system. So Saudi's still going to use the SWIFT system. They're going to use dollars. That's all there is to it. They ultimately will get converted, and so all of these entities. So the scam is this: is that everybody is going to, like I just said, they're going to be trying to sell you something based on the dollar is going to collapse, because now the dollar is no longer reserve currency, air quotes. It's now, the Saudis are ditzing. No, they're not. They're still taking dollars. They're just taking other currencies as well. They'll take all the dollars you'll give them. They'll have no problem with it. And like I said, and early on, early on in the whole sanctions and everything of that sort is where all this came from. This is a classic, I guess, unintended consequences, that when you start to block and you steal money from somebody else's central bank, and you do start to put a lot of questions. If you're in another country, maybe there is something like the euro, there's a BRICS currency, there's nothing there right now. And what's the weighting going to be? Is it going to be to the yuan? Like DXY is heavily weighted to the euro. Okay, that's the biggest weighting in that basket. So how do you weight the BRICS? How do you do these things? It's going to be yuan, and and listen, they've got the major population of the world would be in the BRICS, because you've got between just China and India, right? You've got, 2 2.3 billion people, something like that. That's a close enough to that number. But all the population of the BRICS way outdo the population of the West. But in the end, everybody's still the way the money is flowing at the moment. Even if we ultimately did go away from the dollar, that is a gradual shift. It's going to be very, very incremental. And this is the beauty of the world and capitalism, is when shifts like that happen, the markets adjust to them and they balance out a lot easier than everybody said. What everybody's telling you is that somebody flipped a switch and now everything's going to roll over. And it never works that way. I shouldn't say never. Most of the time it doesn't. And what you really get is where when a shift happens, it's going to be gradual, and maybe more and more people want to transact in other currencies. That could happen. I'm not denying that isn't going to happen at some level, but it's going to be more incremental, and it will be more balanced instead of just completely bifurcated as you even do this or you do that. It's not going to work that way, because China wants to trade with the U.S. Everybody wants to trade. Russia would trade with the U.S. if it wasn't for the sanctions. And I'm sure, I think if you folks, this is, I saw Lindsey Graham actually said the quiet part out loud the other day, folks. He said that we can't let Russia get Ukraine because there's trillions of dollars of resources there. So we want them. We can't give them to Russia. That's why we're there. They want the resources. They don't care about the Ukrainian people. It's about the resources. So, yeah, it's the whole the whole thing's a scam, right? Yeah, and I agree with, other currencies like JPY and currency. Listen, with demographics changing so drastically, India is the only country that has actual demographic growth of population. Everybody else is shrinking. Everybody else. And the Japanese, I was joking with a friend of mine the other day, we'll be lucky in 20 years if there's 3 Japanese left on the planet. They're just imploding demographically. Who's going to make Toyotas? Somebody else. It's interesting from that standpoint. So anyway, great hanging out with you folks. It's been a while. It really, I hope there's some things you can garner from this. It was just kind of a ranting session. Get the Substack, so make sure you get that, kendallreport.substack.com, or you can go to kendallreport.com/newsletter. It takes you basically the same page. And I would tell you folks, if you're considering getting the indicators, get them. We're going to do this mastermind that's coming up. It's going to be 6 hours. It's going to be 2 hours a week for 3 weeks. We'll announce the time. There's going to be a small cost to get in. It's not. I think it's going to be worth it. And I'm just trying to organize what time I have to deal with stuff, and I think I'll be able to deliver this. And I'm going to put out a document. It's going to be those of you that were in the old live trading room. It was somewhat random. I just kind of showed up and we traded and we did some stuff. This is going to be a very educational type event from that standpoint, because I think. There's going to be a lot to be garnered. We're going to do Q&A back and forth. It will be on a Zoom meeting, so we'll have the ability to discuss things. There's some of you out there have discovered some crazy cool things that I've seen. As I told you in the beginning, if you're here and you didn't hear the very beginning of this stream, if you want to get on the personal Discord, you get into that by buying the indicators. And that's kendallreport.com/indicators. If you're already in there, ask questions. I'm going to be reviewing that. I'm going to try to do at least a video a week that's going to be answering questions about things that are going on there. I started to answer some things in Discord, and I thought, no, this is too wonky. I'm just going to do it on YouTube, and I'll put out like a short, maybe 10 minutes out there. Yeah, hey, no Smurfs around. Good call there. No one knew I was doing this, okay? So I just kind of impromptu. I was getting ready, trying to figure out what I was going to do tonight, and I just kind of went through. I thought, you know what? I'm just going to light the screen up. Yeah, so lots of little rants in and out, and yeah, I don't know where all the Smurfs are. There's nobody around, huh? I guess they got another job somewhere. Anyway, at least we don't have any weird folks that I saw hanging out to cause any crap, like sometimes we'll get some trolls hanging around. But anyway, folks, thanks. I don't know when I'm going to do another live stream. This was kind of impromptu, but like I said, Substack will be out later tonight. I'll do that in a couple hours. I try to get, yeah, hit that like button if you're watching right now. 191, doesn't hurt. Just hit the like. Let YouTube know that you're hanging out. Appreciate it. And yeah, so like I said, a couple other videos coming out this week, a couple things that I think you'll find interesting, and I'm going to continue to try to do more of the educational content, and occasionally we'll do a get together like this. So thanks for hanging out. Appreciate it. We made it without the Smurfs. So anyway, take care. Thanks again for watching. Hit that like button before you go. We'll talk to you real soon.